If you are 65 or older and you have more than about $6,000 just sitting in your checking account right now, there is a very good chance it is quietly costing you money in one way and putting you on a federal list in another way, and almost nobody has ever explained either one to you in plain English. I'm going to walk you through both of those today, and heads up, this is general education based on how the IRS and your bank actually work, not personal financial advice for your specific situation. Now let's get into the number that matters, because this one alone could be worth $800 or more a year, every single year, for doing basically nothing. Here is the scene I want you to picture, because I'd bet a lot of you are living it right now without even realizing it. Your Social Security deposit lands on the 3rd of the month. Maybe a pension check lands a week later. Maybe there's an RMD, a required withdrawal from your IRA, that gets swept in once a year. And instead of moving any of that money anywhere, it just stays, sits right there in checking, month after month. Because checking feels safe. It feels like the responsible thing to do. You worked your whole life, you don't want to gamble with it, so you leave it where you can see it. Here's the problem nobody tells you. A checking account is not a safe. It is a leaky bucket. The average checking account in this country pays close to 0% interest. Not low, zero, for all practical purposes. Meanwhile, the cost of your groceries, your Medicare Part B premium, your property taxes, all of that keeps climbing every year. So while your balance number stays exactly the same, what that number can actually buy you shrinks a little more every single month. Nobody sends you a letter about it. There's no bill. It just quietly happens. And that's only half of it. The other half is the part that makes people nervous, and it has to do with what your bank is legally required to report about your account to the federal government. Most retirees have heard some version of this rumor, that if you keep too much money in the bank, someone is watching, someone is going to flag you. Almost everything you've heard about that is wrong, and by the end of this video, you're going to know exactly what's true, what isn't, and the precise number where your bank actually has to file paperwork on you. Before we go further, here's where this comes from, so you know I'm not just making this up. The bank reporting rules come from federal law under the Bank Secrecy Act, enforced through the Financial Crimes Enforcement Network, which most people just call FinCEN. The FDIC insurance limit is set by federal law and administered by the Federal Deposit Insurance Corporation. And the tax pieces, the standard deduction, the extra deduction for seniors, how your Social Security gets taxed, how RMDs work, all of that comes straight from the IRS code, the same rules your tax software uses every April. None of this is a theory. It's the actual rule book. I'm just going to translate it into English. Let's start with the number that actually costs you real money every year, because this is the one that's silently draining accounts all over the country, and it has nothing to do with the IRS watching you. Number 1. Every dollar sitting in checking above what you actually spend in a month is a dollar earning you nothing. Let's say you're like a lot of retirees and you're carrying $15,000 in checking, way more than you spend month to month, just because it feels safer that way. If that same $15,000 were sitting in a high-yield savings account instead, paying somewhere around 4% in 2026, that's roughly $600 a year, landing in your account without you lifting a finger. Over 10 years, with the interest building on itself, that's closer to $7,000 you simply gave away for the privilege of feeling cautious. Most retirees never do this math. They just see a bank statement, see a positive number, and assume everything is fine. It is not fine. It is a slow leak, and it happens every single month, whether you notice it or not. Now here's where it gets important, because this next one stacks right on top of that. Number 2. Inflation is a second, quieter tax on that same idle cash, and it hits you even harder than most people realize once you're living on a fixed income. If you're retired and your income is mostly Social Security and maybe a pension, your income doesn't automatically stretch to match rising prices the way a paycheck sometimes does. So when your checking account earns 0%, while the cost of everything you buy climbs 3 or 4% a year, that money isn't just standing still, it's losing ground. A dollar you're not using today buys noticeably less 2 or 3 years from now. For someone on a fixed income, that's not an abstract economics lesson. That's the difference between your money lasting through your 80s and running thinner than you planned. Most people stop here, but don't, because the fix for both of these is the same, and it takes about 10 minutes, and we're going to get to the exact playbook before this video ends. Number 3, And this is where we get into the part you actually clicked for, the $10,000 rule. Here's the truth, and I want to say this clearly because there is so much bad information floating around about it. There is no law that says you cannot keep a large amount of money in your checking account. Nobody is watching your balance and waiting to pounce because you've got $20,000 or $30,000 sitting there from selling a house or from a life insurance payout. Having money is not against the law, and a high balance by itself triggers absolutely nothing. What actually gets reported is not your balance. It's a specific kind of transaction. If you deposit or withdraw more than $10,000 in cash in a single transaction, federal law requires your bank to file something called a currency transaction report. It goes to FinCEN automatically. Here's the part almost everyone gets backwards. That report is not an accusation. It is not an audit. It's not the IRS calling you in for questioning. It's a routine form the bank files thousands of times a day for perfectly ordinary reasons. Someone sold a car, someone cashed out a CD, someone got a down payment from a family member. If that's you, you have done nothing wrong, and in the overwhelming majority of cases, absolutely nothing happens next. It just sits in a database, unread by anyone. Here's the part they never tell you, though, and this is the one that actually matters for you. The real danger isn't the $10,000 report. The real danger is what people do to try to avoid it. It's called structuring. That means deliberately breaking up a large amount of money into smaller pieces to duck under that $10,000 line, depositing $9,000 today, then the rest next week, on purpose to stay under the radar. That is a separate federal crime, punishable by up to 5 years. And here's the part that should genuinely bother you. It doesn't matter one bit whether the money was completely legal. You can have earned every dollar honestly and paid every penny of tax on it, and still get flagged purely for how you moved it. Retirees have had money seized this way. Someone sells an inherited property, gets nervous about the government seeing it, and starts making careful little deposits under $10,000, thinking they're being smart. That is the single most dangerous thing you can do. The lesson is the opposite of instinct. If you're moving a large amount, do it in one normal transaction. Let the boring report get filed. Never try to be clever about the line. Number 4. And this one is quieter, but it's the one that actually watches your everyday account. Beyond that $10,000 cash rule, banks also run software that looks for a suspicious activity report, or SAR. This one isn't tied to a specific dollar figure, it's tied to patterns that look unusual for you specifically. A sudden deposit that doesn't match your normal Social Security or pension income. A string of deposits that all land just under $10,000, which looks exactly like structuring even when it isn't. Frequent wire transfers, especially overseas, something that unfortunately shows up a lot with retirees who've been targeted by scams. Cash activity in an account that's normally all electronic. Money moving in and immediately moving back out. None of these are illegal on their own, and you could have a perfectly innocent reason for any of them. But now you understand the machine, and the way you stay invisible to it isn't by hiding anything, it's by being boring, consistent, and honest. Which, if you're like most people watching this, you already are. Now here's where it gets important for anyone thinking about retirement specifically. Number 5, your required minimum distribution, the money the IRS forces you to pull out of your traditional IRA or 401k once you hit the RMD age, currently 73 under current law, often lands in your checking account as one lump sum, sometimes tens of thousands of dollars at once. Most retirees just let it sit there afterward because moving it feels like extra work. But that lump sum is exactly the kind of idle cash we talked about a minute ago, earning zero while it waits for you to decide what to do with it. If you don't need that money for daily expenses, the smart move is to sweep the part you don't need into a high-yield account within days of it landing, not months later. Every month you wait is a month of lost interest you're never getting back. Here's the part they never tell you. Number 6, and this is the one most retirees have literally never heard of. Your money in the bank is protected by FDIC insurance, but that protection has a hard ceiling, $250,000 per depositor, per bank, per ownership category. If you've got more than $250,000 sitting in a single account, at a single bank, under a single name, the amount above that line is not insured. If that bank fails, and banks have failed in recent years, including some fairly large ones, the money above the line is, in the worst case, simply gone. This matters more for retirees than almost anyone else, because you're the group most likely to have a lump sum sitting around. The proceeds from selling a house to downsize, an inheritance, a life insurance payout, a pension buyout. If any of that landed in one account and you haven't touched it since, go check that number today. The fix is completely legal and it costs you nothing. Per bank means if you spread your money across 2 or 3 banks, each one gets its own $250,000 umbrella. Per ownership category means an individual account, a joint account with a spouse, and a retirement account at the very same bank are all insured separately. And there's a trick almost nobody uses. Adding a payable on death beneficiary to an account can extend your coverage even further, because each named beneficiary adds another layer of insurance on top of the base limit. It takes about 5 minutes at your bank, in person or online, and it's free. Number 7, and this ties the tax side directly back to that checking account balance. If your idle cash finally starts earning real interest in a high-yield savings account, that interest counts as taxable income, and it can affect more than you'd expect once you're retired. Extra interest income can push more of your Social Security benefit into taxable territory, since up to 85% of your benefit can become taxable once your combined income crosses certain thresholds. It can also, in less common cases, nudge your income high enough to affect your Medicare Part B and Part D premiums through IRMAA, the income-related monthly adjustment amount, which uses your tax return from 2 years earlier to set your premium. None of this means don't earn the interest. Earning 4% and owing a little tax on it will always beat earning 0% and owing nothing on nothing. It just means don't let it surprise you every April. Your bank will send you a form called a 1099-INT for any account earning more than $10 in interest, and that number needs to show up on your return. Number 8, and this is the one that quietly saves people the most money if they actually do it. If you're 65 or older, the IRS gives you an extra amount on top of the regular standard deduction on your federal return simply for your age, no application, no form to prove anything. It's automatic once you check the right box when you file. Most retirees who use simple tax software get this correctly, but a surprising number of people who still use an old paper method or who haven't filed their own taxes in years miss checking that age box and leave real money on the table every single year. It won't change what's sitting in your checking account today, but it directly affects how much of that Social Security and interest income actually gets taxed, which is exactly why it belongs in this conversation. Here's the part they never tell you. Number 9. Not every savings-sounding account is the same, and mixing them up costs people money every year. A high-yield savings account is a plain bank product, fully FDIC insured, and it's exactly where your emergency cash and your near-term Medicare or property tax money should live. A money market account is a close cousin, also a bank product, also FDIC insured, sometimes with a debit card or check writing attached, which makes it a convenient middle ground. But be careful, because a money market fund is a completely different animal. That's an investment held at a brokerage, not a bank, so it is not FDIC insured, even though the good ones hold nothing but short-term treasuries and are considered extremely safe. And then there's a CD, a certificate of deposit, which locks your money up for a fixed term, 6 months, a year, sometimes longer, in exchange for a guaranteed rate. The catch is the lockup. Pull it out early and you pay a penalty. So a CD is a great tool for money you already know you won't touch until a specific date, like a property tax bill due next spring, and a terrible tool for anything you might need on short notice. Match the account to the timeline, and you'll never get caught having to break something open early just to pay a bill. Number 10, and this one closes the loop back to where we started. If you're managing money for a spouse, or you're the one helping an aging parent with their accounts, the structuring rule from a minute ago applies just as much to you as it does to anyone else, and it's worth repeating because it trips up caregivers constantly. If you're helping someone move a large sum, say closing out a CD or consolidating accounts after a spouse passes away, do it as one clean transaction, and let the paperwork happen naturally. Well-meaning family members have gotten themselves in serious trouble trying to keep things simple by moving money in careful, smaller pieces because they thought a big single transaction would look suspicious. It's the opposite. The big single transaction is the boring, normal, unremarkable one. The small, careful pieces are the ones that raise a flag. So if checking should only be holding 1 to 2 months of real expenses, where is everything else supposed to go? Think of it as 4 buckets in order. Bucket 1 is checking, 1 to 2 months of your actual spending, plus a small buffer, full stop. Its only job is paying bills without you thinking about it. Bucket 2 is your emergency and near-term cash, 3 to 6 months of expenses plus anything you're setting aside for property taxes, home repairs, or a known Medicare premium bump. And that lives in a high-yield savings account, fully FDIC insured, earning real interest while it waits. Bucket 3 is money you'll need in the next 1 to 3 years, and that's a good home for a money market fund or short-term treasury bills, both considered extremely safe and both currently paying a rate well above what checking pays you. Bucket 4 is money you genuinely won't touch for 5 years or more, and that's the only bucket that belongs anywhere near the market, inside your existing retirement accounts, growing for the long haul instead of sitting in cash losing ground to inflation. Before we wrap up, let's go through the handful of mistakes that quietly undo everything we just covered, because knowing the traps in advance is half the battle. The first mistake is panicking about the $10,000 reporting rule and trying to outsmart it by breaking up deposits. We already covered why that turns a non-event into a real legal problem, and it's worth remembering every single time you go to the bank. The second mistake is letting a windfall, an inheritance, a home sale, a life insurance payout, sit in one account long enough to drift past that $250,000 FDIC line without you ever noticing. The third mistake is chasing a flashy teaser interest rate, moving all your money to grab an extra 0.5% for 3 months, and then forgetting to check when it quietly resets back down to nothing. The ongoing rate matters far more than the introductory one. And the fourth mistake is the one this whole video is built around: treating checking like a savings account and letting thousands of dollars sit there earning zero while it slowly loses ground to inflation. Okay, here's exactly what I want you to do this week, because information without action doesn't put a single dollar back in your pocket, and this whole thing takes less time than a trip to the pharmacy. Step 1. Pull up your last checking statement and look at the actual balance sitting there right now, not what you think it is, what it actually says. Step 2. Add up what you genuinely spend in a normal month: rent or mortgage, groceries, utilities, insurance, the Medicare premium that gets deducted automatically, and multiply that by 1.5. Then add a couple $100s of buffer on top. Write that number down. That's your checking line. Step 3. Subtract your checking line from your actual balance. Whatever is left over is money that's been quietly losing value every single month it sat there doing nothing. Step 4. Open a high-yield savings account this week. It takes about 10 minutes online or a short visit to your existing bank. Look specifically for the words FDIC insured. Confirm there's no monthly fee and no minimum balance requirement, and ignore any teaser rate that expires in 3 months. Look at the standard ongoing rate instead. Step 5. Move that leftover money over. If the total sitting in any one bank across all your accounts combined is getting close to $250,000, this is also the week to ask about adding a payable on death beneficiary or opening a second account at a different bank, so every dollar stays fully insured. Step 6. If you've got a lump sum you won't need for 1 to 3 years, say, money set aside for a future home repair or a car, ask about a treasury bill or a short-term CD, timed to when you'll actually need it, instead of letting it sit in checking the whole time. That single sequence is worth more than almost anything else in this video. If this explains something about your own accounts that nobody ever laid out for you this clearly, hit subscribe, because every week on this channel we break down exactly what the IRS, Social Security, and Medicare actually expect from people over 55, in plain English, with no scare tactics and no jargon. Next up, I've got a full breakdown of exactly how your Social Security gets taxed, and the specific income number where that 85% threshold kicks in, because once you understand that number, a lot of the decisions in this video get even easier.